Hello and welcome back to the channel. Today we bring you a full update on gold prices as of January 30th, 2026. In this video we cover both the global gold market and the US gold market. We will explain the key price levels and the driving forces behind today's price movements. And at the end, we invite you, our viewers, to share your own opinions in the comments. Let's dive right in. First, let's talk about the global gold market. On January 30th, 2026, gold prices experienced a significant movement. Global spot gold traded sharply lower during the session. At one point, prices were down more than 6% compared to the previous day. By the end of the trading day, spot gold was hovering around $5,000 per ounce. That is a notable drop from recent highs. Just days earlier, gold had been trading near record levels. So a reversal of this magnitude drew attention from investors worldwide. The drop in global gold prices was one of the major financial stories of the day. The decline showed that sentiment shifted quickly during the session. Many traders were caught off guard by the speed of the sell-off. Let's break down why this happened. One key factor was the movement in the US dollar. The dollar strengthened significantly against most major currencies. A stronger dollar tends to put pressure on gold prices. That's because gold is priced in US dollars. When the dollar gets stronger, gold becomes more expensive for holders of other currencies. This reduces demand. Another factor was expectations around interest rates. Investors started to adjust their views on future rate cuts. Some believed that the Federal Reserve might not cut rates as quickly as previously expected. Higher interest rate expectations reduce the appeal of gold. That's because gold does not pay interest. That means it becomes less attractive compared to yield-bearing assets. So these economic forces contributed to the sell-off. Global markets are always interconnected. What happens in one major economy influences others. For gold, global sentiment shifted from risk-off to risk-on at certain points. When risk-on sentiment increases, gold often weakens. The session on January 30th showcased this dynamic. The price decline was significant enough to draw attention across global markets, and the volatility will likely be talked about for weeks. But we also observed that long-term demand for gold remains intact. Many investors still view gold as a hedge against uncertainty. So while prices moved lower in the short term, long-term trends may differ. Let's now look specifically at the US gold market. In the US, gold futures on the COMEX saw heavy trading volume on January 30th. Price action in the US market mirrored global price movements. COMEX gold futures also declined significantly during the session. The US market opened with selling pressure. Investors reacted to economic data and policy signals. The most closely watched signal related to potential leadership changes at the Federal Reserve. Discussions about the next Fed chair triggered shifts in expectations. As rate expectations changed, so did gold trading behavior. Many traders decided to take profits. Profit-taking accelerated the price decline. Some institutional players adjusted their positions throughout the day. This added to selling pressure. By midday trading, gold futures had already lost several percentage points. And by the close, losses expanded further. That made January 30th one of the more volatile trading days in recent memory. Traders watching the session described it as dramatic. Some analysts even compared it to historical moves from decades earlier. This was a dramatic shift compared to recent price hikes. Just weeks earlier, gold had been trading near all-time highs. So the contrast in price behavior was stark. Let's break down the key price figures. Global spot gold was around $5,000 per ounce. US COMEX gold futures showed similar pricing levels. These prices reflected the market reaction to global macroeconomic developments. The US dollar index surged during the same period. A stronger dollar puts additional downward pressure on gold. We saw the highest levels of dollar strength in weeks. That strength played a large role in driving gold lower. Meanwhile, treasury yields also climbed. Higher yields reduced the opportunity cost of holding gold. That created another headwind for gold prices. Many investors rotated funds into yield-bearing assets. This further reduced demand for gold. As a result, gold futures prices continued to slide. Short sellers capitalized on the downward momentum. Their selling reinforced the price drop. But it's important to note that long-term investors remain active. Many continue to view gold as a safe haven. This safe haven demand remains resilient. In It may support gold prices over a longer time frame, but short-term volatility is still high. Traders should be prepared for sudden price swings. So what were the major drivers? First, dollar strength. Second, shifting expectations about interest rates. Third, profit-taking after recent rallies. Fourth, strong trading volume and institutional positioning changes. And fifth, macroeconomic news that impacted trade sentiment. Each of these contributed to the powerful move on January 30th. When multiple factors align, markets can move quickly. And that was exactly what we saw. Let's look a bit more at the role of the US dollar. Traditionally, gold and the US dollar have an inverse relationship. When the dollar rises, gold tends to fall. And when the dollar falls, gold tends to rise. This inverse relationship held true on January 30th. The dollar index surged during the trading session. This put immediate pressure on gold prices. Traders responded quickly to currency market moves. Some analysts say the dollar rise was the dominant factor. Others point to interest rate expectations. Both likely played a role. But the end result was clear: downward movement in gold. The Federal Reserve's policy outlook affects markets. On January 30th, traders reassessed rate expectations. This reassessment reduced the likelihood of near-term rate cuts. When the market anticipates tighter policy, gold often suffers. That's because rate cuts typically boost gold demand. Higher rates create stronger yield opportunities elsewhere. This dynamic reduces gold's appeal, so shifting rate expectations contributed to selling. Gold is sensitive to changes in monetary policy. Investor sentiment shifted during the session. At the start of the day, many held long positions. But as prices fell, sentiment turned cautious. Some traders reduced their exposure to gold, others chose to hedge their positions. Hedging adds selling pressure in the futures market. This amplifies price moves. Traders who raise cash during the sell-off may re-enter later, but timing is difficult during volatile periods. We saw rapid swings throughout the session. These swings reflect uncertainty in the market, and uncertainty often leads to above-average volatility. So what does this mean for you? First, short-term volatility may continue. Expect price swings in both directions. Second, watch the dollar and interest rate news closely. These will likely remain key drivers. Third, long-term fundamentals may still support gold. Safe haven demand remains strong. Fourth, risk management is critical in volatile markets. Traders should consider position sizing carefully. And remember, markets can change quickly. Stay informed with real-time data. Some analysts say the sell-off may be a buying opportunity. Others warn that downward pressure could continue. Both views have merit. Market sentiment is divided. That's normal in periods of high volatility. Long-term investors may see value. Short-term traders may react to technical signals. At today's prices, gold may appear more attractive than yesterday. But only time will tell how prices evolve. Now we want to hear from you. Do you think the gold sell-off is over, or will prices continue to fall? Share your thoughts in the comments. What price level do you think gold will reach next? Will it bounce back above $5,000 or test lower support levels? Tell us what you think. Do you trade gold futures? Or are you a long-term investor? Let us know your strategy below. We want to feature your comments in our next video. Your opinion matters. And we read every comment. Let's summarize. On January 30th, 2026, gold prices dropped sharply. Global spot gold fell toward $5,000 per ounce. US COMEX futures also declined significantly. The US dollar strengthened. Interest rate expectations shifted. Profit-taking accelerated selling. Investor sentiment became cautious. Volatility spiked. Long-term demand for gold remains relevant. Safe haven appeal still exists, but short-term pressures dominated trading. What might happen next? The market will watch Federal Reserve signals. It will watch dollar movements. It will watch economic data releases. Inflation readings could influence gold. Employment reports could impact sentiment. Geopolitical news also matters. Any unexpected news can move prices, so stay tuned. Keep learning and educate yourself on macroeconomic trends. If you like this update, hit the like button. Subscribe for more market insights. Hit the bell icon so you never miss a video. Share this video with others interested in gold markets. And again, leave your thoughts below. Which price level are you watching? What's your gold forecast? Do you think gold will head higher or lower next week? We want to know. Thanks for watching. We'll see you in the next video. Stay safe and stay informed.